what we're doing and before I show you guys what we're doing with the SmartMonics strategy, I want to take just a moment here to be able to introduce myself. All right, I'm very, very big on relationships. And I believe that for many, many years, we go about building the business and looking at what we're doing in the wrong way. Many years we go and we edify talent instead of edifying character. I'm a very firm believer that talent will take you so far and character will carry you the rest of the way. Because when you have a good heart, I really believe that your God, whoever believes in, if you, I don't want to step on any lines over here, but I do believe that God will bless you when you have a good heart with fortune and abundance. And I always pray to God and I always ask God, I say, God, use me as a vessel. Allow me to help feed your people. Allow me to be the vessel to be able to educate your people, because we live in a world, we live in a day, we live in an age right now where sometimes good is just not good enough. And we are in a race and we have to be able to get ahead. There is a clock that is counting, and the clock is our bank account. If you guys were to stop working right now, literally stop working right now, and you had to live off of the money in your bank account, that will let you know what your true measure of wealth is. So if I stop trading, if I stop building, if I stop my business, if I stop everything, how many years can I go before I run out of money? You see, and I understand that this is not just a situation for me. This is a situation for every single person that is out there. And I'm all about equality. I believe that no man or woman is above, less, greater than anybody else. I believe some people are more ahead in life because they started earlier, but I don't believe people are above or below anybody. And I always keep that in my heart. And because that is in my heart, and because somebody shared this opportunity with me, put me in this position and allowed me to be able to learn and get educated, my life has transformed over the last 7 years trading within this space, and quite phenomenally. And I couldn't be more grateful. And I want to be able to share that gratitude by giving back. So this is why every time I get on a Zoom, every time I get on a Go Live, I'm always giving my all. If I need to be there for an hour, if I need to be there for 2 hours, because it is truly people over profit. Okay. We make an income while making an impact. So that's why I'm here with you guys today. And I just want to encourage everybody and let you guys know, it does not matter if you are in your first chapter, page 1, or if you are in chapter 20 in your book of life, you are just getting started and great things are to come. So I'm very excited right now to be able to introduce you guys to the SmartMonics strategy. So I could go on the light side, or I could go a little bit on the advanced side. I'm not too sure what you guys want, but what I will do is I will cover the 3 steps to our SmartMonics strategy, introduce you guys to the platform. Is there anybody here that does not trade with the harmonic scanner? If you do not trade with the harmonic scanner, just type NO for me inside of the chat box if you don't use the harmonic scanner, because our entire strategy is wrapped around the harmonic scanner. Now look here, we have, woof, that chat box is blowing up with no's right now. Okay, so I'm going to get ready to share my screen. But before I share my screen, I want to say this as I take you guys through this journey of learning how to trade SmartMonics. All righty. So with the harmonic scanner, I'm actually, you know what I'm going to do? I'm going to share some quick slides for you. I'm going to have you guys really understand what's going on. And then I'm going to walk you guys through the strategy. I'm a very firm believer that you should be a connoisseur of knowledge and information. You should want to know what you're trading, what you're doing, why it works. What's the mechanics behind it? So we're going to talk about this, how to unleash your potential. So this, what we're about to show you, this harmonic scanner, this is actually our company's flagship strategy scanner for 20 plus years. This is the same scanner that our CEO 10 years ago when he started IM, and 10 years before that when he first started bringing trading education to the masses. Okay, this was the same scanner that he has been using for over 20 years. This is the scanner that not only helped our CEO amass his wealth and become such a successful trader, flying around the world, being featured on television, being featured at trading expos, but this is the same exact scanner that so many students in the company seen success with. But because things can feel complicated, people stop using what works. I am not a person that likes to reinvent the wheel. If my CEO was able to make more money than I've ever seen in my lifetime using this strategy scanner, I'm going to follow in his footsteps. They say, do as they do and you will get as they have. So this is a 20-year scanner with proven results. All right. And the harmonics is simply, it's just a powerful algorithm that utilizes Fibonacci's ratios. And what we call that is, we call that God's math. I truly believe that when you go down to the protons and the neutrons and the atoms that vibrate in our body, that create the energy that turns into the physical, all the way down to the cells, it's all mathematics. It's all binary, ones and zeros. There is a hidden math in the universe, and people have learned how to utilize that math inside of the market. And it ended up becoming phenomenal. And we're gonna actually walk you guys through that today. So this is a powerful algorithm that utilizes Fibonacci ratios to define precise turning points, because the market is what? It's all about the entry, where you're getting in, where you're getting out. And we want to show you guys how to become sharpshooters inside of the market. We want to show you exactly where to get in and where to get out of the market. Okay. So now, just so you guys know, the harmonic scanner, it works on all time frames. It works on all major assets. If you want to trade gold and commodities, you want to trade indices like US 30s and NAS 100s, you want to trade regular Forex pairs, they're all available on the harmonic scanner. So it's going to basically give you all the possibilities, and it's going to be all at your fingertips every single day. In my opinion, this is the best scanner in the entire planet of trading. Okay. Now the harmonic scanner is very simple. So I'm going to walk you guys through the harmonic scanner. This harmonic scanner does give you guys over 100 scans a week. So I want to let you guys know that the opportunity is plentiful. It's bountiful. There are many, 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 many opportunities. So you don't have to wait once in a while. Every single day you get to open this up, and there is an opportunity to make a profit inside of the market. All righty. We're always trading with great risk to reward. And this is something that we want to let you know. Now, SmartMonics is harmonics with a little bit of sauce on it. And I want to help you guys understand how this strategy came about and what it is before we go into the 3 steps, because I think the 3 steps are pretty simple. So listen to this. While the harmonic scanner is very powerful, it's not perfect. You see, every opportunity provided is not an opportunity to take, right? It's just the truth, right? We work within the law of probabilities, right? So we have to learn how to identify the right opportunity. When we find the right opportunity, we will be able to reduce our risk and we will be able to maximize our reward. I cannot tell you how many people that I talk to on a one-on-one basis on my team that their losses are so much bigger than their wins. Their formula is backwards. So today I'm going to teach you how to flip that around. I want you guys to win more than you lose. And when you win, I want to teach you how to win big. And when you lose, I want to teach you how to lose a little bit. So when you're wrong fast and you're out the market. But when you're right, woof, sheesh, you are right. So we want to be able to create that experience for you guys. And we're going to collect confidence entering these markets by gaining confirmations using our SmartMonics strategy. Now, what exactly is, right? So what exactly is the SmartMonics strategy? Well, the SmartMonics strategy, this is a 3-step strategy. And we're going to combine the harmonic scanner with smart money, with institutional trading. So we're going to take 2 powerful concepts and we're going to put them together and we're going to make one trading strategy. And this trading strategy right here is going to take you through the roof. And you know how we know the trading strategy is good? It's because every single day we document the trades. So ever since we started publicly trading this strategy, we began recording our results on Go Live. We began recording these results on November 29th of 2022. From November 29th, 2022 onto our session yesterday. Now, if any of you guys were on our session yesterday and you guys made some profits, go ahead, type a 111 because I know GOD hit, GN hit, UCAD hit, AU hit. I know they all hit, right? So since then, we have been performing with about a 78% win ratio. Okay. We are at around about a 5%, 4.4% losing ratio. And we're about 16, 17% missed trades, which means that we created an opportunity, but the opportunity didn't trigger. It either missed the entry or it didn't follow the steps. So that's a missed opportunity. And every time you see a green one, that means that we made profits. This was the TPs. And then this is how many pips the trade actually went. The reds are the losses and the grays are any of the missed trades. Okay. And we have some very interesting trades over here. I got to be quite honest, right? There was a trade on GBP odd that it hit our stop loss and then dropped 1,000 pips. And I remember I was so upset at that. But anyway, so we have been doing phenomenal. So we document these trades every single day to give you guys the confidence, and we trade. There is not a single trade on here that we're not doing together on Go Live. You can go to my Go Live sessions and you can see every single one. You can study all of my sessions and you can see every single trade that we have called out here, right? So we want to be transparent. We want to be able to show people trading is possible. The 3-step strategy works and you can make money. Okay. So coming back over here, let's talk about the 3-step strategy, and let me help you guys understand the psychology behind it. Because if you can understand the psychology, the strategy will become more easy. All right. Remember, trading is 90% mental, 10% technical. And so is the market. So many people, you guys get so lost in looking at every up and down inside of the market. You're missing the story. You have to understand what's going on. So I'm going to show you in 2 quick minutes what you need to know. And then for the rest of the time, we're going to actually walk through the steps. So don't disregard anything that we're going to say now. Everything I'm saying to you, it's with intention and for you to understand. All right. So what are the 2 concepts of harmonics and smart money? Well, harmonics is all about seeking balance via something known as the market auction theory. And we'll explain that. And smart money is about the intermarket bank algorithm and how banks need to liquidate retail traders to be able to move the market. All right. So let's take a look at this. So when you see a harmonic scan and you're like, you know what? I'm looking at the harmonic scanner. I'm going to log in right now. You know, you're looking at the harmonic scanner and you're like, what is this harmonic scanner? Like, what is the purpose of the harmonic scanner? Right now, all of my markups are also saved over here. All right. So I'm just trying to find one with no markup, right? This one went great, but we didn't mark this up. So I'll use this one. Okay. So when you look at this harmonic scan right over here, and you're wondering to yourself, you're saying, what exactly is harmonics? What's the purpose? Is it just, you know, these Fibonacci algorithms that are coming together? No, 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 no. It's actually something a little deeper than that. Okay. So harmonic scans seek to balance the market via something known as market auction theory. Market auction theory just basically says that something has to always be at fair value, right? So like, let's say you want to buy an iPhone. The iPhone right now is worth anywhere between $800 to $1,000. So if the iPhone is over $1,000, if you get an iPhone and you can sell it for $1,200, you know you're going to make a profit. And if you buy the iPhone for $600 and you know it's worth $800, $900, you know you're getting a discount. So there's always a fair value. And we do this in life. We're willing to pay the fair value for sneakers, for food, for laptops, for whatever we want. If it's a fair price, we'll get it. If it's really cheap, we'll definitely get it. If it's too expensive, we won't buy it or we'll sell it to make money. So this is what the harmonic scanner is actually about. You see, there is something known as fair value. So fair value is like an area of consolidation. It's the fair value. Now, what happens is when the market drops, and that's X to A, when the market drops and the market goes into a trend, this creates an imbalance in the fair value. And what happens is if you see the A, B, C correction that makes the harmonic scan, this is the market trend rebalancing itself, bringing the market back into a fair value price. So the market's always looking to balance itself out before it continues trending inside of the market. And we have to understand that because when we're trading in the market, you can, if you really look, if you really take a look, you will see the market will go from a fair value to a trend, and then it will rebalance. Okay, the market will then rebalance, and then the market will trend, and the market will look for fair value and go back into consolidation, and then go into a trend. And then the market will rebalance and go into a consolidation. And this is obviously a very long consolidation. I could do a few, and then it'll go into a trend, and then it'll rebalance, right? It'll rebalance. And that's what it's doing here. This was the fair value, right? X to A, and then A, B, C was where the market decided to go back into fair value. And once the market was at fair value, everybody sold it off. Now, is this something that you're going to be paying attention to every single day inside the market? No, you're not going to pay attention to it every single day, but it's good to just understand, why does the harmonics even exist? Okay. Now from there, we're now going to next talk about smart money. Okay. So now when it comes to smart money seeks to liquidate retail trading value. So what exactly does that mean? Well, very simple. Look, it's almost just like the harmonic scanner, right? It's just different ways of looking at the market. That's why we mix the two of them together to create the best trade ideas possible. So this is what happens. So with smart money, what does it mean that it seeks to liquidate? So I'm going to give you guys a little secret. Did you guys know that in order for the market to move, ready? In order for the market to move 1 pip, so if the market goes from 1.7900 to 1.7901, did you know that that is the equivalent of 10,000 lots being traded to move the market 1 pip? Did you ever think about that? 10,000 lots. So it takes $1 million to move the market just 1 pip. So if you look at the market from here to here, this is 180 pips. So if that was 180 pips, that took $1.8 billion to move the market from here to here. Or no, 180 million dollars. It took $180 million to move the market from there to there. And if you hit a TP, what did you make? $100, $200, $500, you know? So you don't realize there is so much money to move the market. Now, this is the thing, is that if you guys remember how the markets are made, guess what? 5% of the market are retail traders. That's all of us. You can get every single person in the world to come together at the same place at the same time to put in the same buy, and we will not even scratch. We won't even move the market. We are retail traders. We'll never do it. 95% of the market is controlled by the institutions and by the banks, right? So when an institution, when a bank wants to come in, Goldman Sachs, Citibank, Chase Bank, Bank of China, when these banks want to come in and they need a trade, when they put in a buy, the market goes high. When they put in a sell, the market moves. The market moves when the banks trade. Exactly, the whales, right? Dessa knows. So in order for the banks to come in the market, do you think that the market is in the game of you making money? The market's not in the game of you making money. No, there is something known as the intermarket bank algorithm. And this intermarket bank algorithm is always monitoring the buys and the sells inside of the market, okay? And what they need to do is, in order for, let me show you here, in order for the market to be able to move, let me come over here, pardon me, right? In order for the market to move, the banks needs to liquidate as much money. And I'll give you an easy explanation so I don't stay all day on this. How many of you guys have ever gotten into a trade that it hit your stop loss and then it went to your take profit? How many people has that happened to? So you lost money on the trade, but you was right on the analysis. How many people has that happened to? It happens to almost every single person. Why? Because what happens over here is that the market needs to accumulate volume. So they're gonna start accumulating volume. They're gonna start getting a lot of money inside of the market. So that's where you start seeing a lot of this like consolidation. You'll start seeing a lot of consolidation. This is the fair value. This is the market accumulating all of the value. Now, this can happen on smaller scales here as well, right? So this is the market accumulating all the volume. So they need to accumulate all this volume. And once they accumulate the volume and then they push the market, the sellers are saying, oh my God, I'm ready. I'm going to sell. All the sellers start putting in a sell. And then what happens is the market pulls back and hits all of your stop losses. And you're like, oh man, is it going to sell? Is it going to buy? And you're a little confused. And then the buyers are coming in. The buyers are like, I knew it. I knew it. The market's going to go up. I knew it. Then the buyers get in because they're overconfident. Then the buyers get in and beep, 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 beep. And the buyers think that they're about to make money. But then what happens is once the market liquidity, once they absorb all the orders, they get all the buys, they get all the sells, they absorb all of the money, they absorb it, they liquidate all the traders, they clear out the sellers, and then they drop the market and they'll clear out the buyers, or vice versa if it's a buy example. And they'll clear out the market and then you'll see a big move come in. Have you guys ever noticed when big moves happen, they don't happen over time, they happen quick? Big move, quick, big move, quick, big move, quick, big move, quick. But then it's like you're in consolidation all day long. So smart money is all about learning how to get in where the whales get in, knowing exactly where the banks are gonna trade inside of the market so you can get in when the market is ready to move. So I hope I was able to explain that correctly. So now what I found out was that the harmonic scanner and smart money are actually a perfect combination. It's like two sides to a quarter, heads and tails. When you put them together, it is so powerful. And what I had to do was once I figured this out, I said, okay, how can we create a simple 3-step strategy that's going to allow us to be able to get in the market when the market is ready to move? And that's how SmartMonics was born. So now that you guys have a better understanding of the psychology of what these two concepts are, I want to show you guys how to capitalize on it. Okay, so if you guys want to have these results, not just trading with me on Go Live, but you want to have these results on their own, right? You guys have a few people on your team that are getting on my sessions that are catching profits and catching trades that I didn't even call out, but using the strategy because it's powerful, it works, it's duplicatable. So now we're going to get ready to be able to show you the strategy, okay? So our strategy is a 3-step strategy. We have step 1 is about identifying the entry zone. Step 2 is we want to identify our entry candle, right? And step 3 is identifying the exact entry price. We want to be as specific as possible. So step 1 is all about identifying the entry zone. So let me talk to you guys a little bit about this, right? The core of the strategy is in identifying the entry zone. So to find the entry zone, we're going to find a liquidity block. A liquidity block is a fancy word for a really strong support or a really strong resistance. We want to look for not any support or resistance. We want to find the best support and the resistance. We want to find the support and the resistance that reveals the pileup of large orders by institutional markets. So we want to find those support and those resistance levels where not retail traders are going to trade. We want to find them where the banks are going to trade. We want to find the ones that have all of the money that's going to move the market. So how do we do that? Well, it's very simple, okay? We're going to find the liquidity block by looking at this price model. So I want you guys to take a screenshot of this price model right here. I want you guys to all take a screenshot right now. This is what you want to see happen in the market in order to find step 1. Because remember, step 1 is all about finding the entry zone. Remember, where there is no liquidity and there is no money, there is no move. We need a big move. We need big money for a big move, okay? So we're going to see where the market is accumulating. We're going to see where the structure is broken. And then we know that the market is going to come back in that area before it takes the market out, okay? And we're going to find that. We're going to show you this over here. It's right over here, but I'm actually going to go through it on the chart with you quickly. Now, remember, this is the bulk of the strategy. Okay. So let me come over here to like a different trade, because there's a lot of markups. There's a lot of TPs on here that we ended up hitting, right? So let me come to 1 hour. Let me see if this one will give a nice clean one. All righty, perfect. We had 1 and we had 2. We could use that one. I'm gonna give another one. All right, we could use this one. All right, so let's remove this. Remove drawings. All right. So we're going to remove this and we're going to take a look at how to find this. So the first thing is that you want to find and make sure that there's a harmonic scanner in place. Now, the reason why I want to use this one is because this harmonic scan hits stop loss. So remember, there's going to be many times that you see harmonic scans that hit stop loss and you're going to think that they're not good, but that's not true. It's not true at all. The market knows that a lot of people are here to sell. So more than likely, they usually are going to push the market up to hit those stop losses and then take the market down. So even if it hit the stop loss, that does not matter to me. I want to make sure that the harmonic scanner is there. So we could see here the harmonic scanners here. Now, what we're going to do again, step 1, we're going to find the best support and resistance, where all of the money is at. So what we want to do is we want to do this. Okay, let's look at the left side of the chart. So if we look at the left side of the chart, we could see here on the left side of the chart that this market is trending, right? Look, the market is going low. The market's making a high, market's making a low, market's making a high, market's making the low right over there, and market's making the high, and then market's making the low, and then market made another high, right? And then market's making a low, and then making a lower high, and then we could see that the trend is starting to reverse. So what I want to show you here is this. What you need to look for is, and I hope you guys can see this. Let me make this a little bit thinner. Okay. I'm going to do my very best to explain this to you guys over here. Okay. Thickness. All right. So we can see the market moving up. Now, this is the thing. If you ever look at a trend, this is how a trend works. And you guys need to know this. Okay. The market is continuing an uptrend every time the market breaks a previous high. So if the market makes a high and then a low, if it breaks the high right there, it's going higher, right? If it breaks the high, it's going higher. So as long as the market is doing this, we know the market's going on an uptrend. You know, most people, they'll come and they'll probably like create a little trend line or something like that, right? Now, eventually what happens is once the market's high, the market is going to start turning around, right? The market is going to stop making those highs. It's going to stop. And again, every time, right? Every single time, let's come over here. Okay, it's a lock. Let me get rid of this. Every single time, I think this is the hardest part of the strategy, but it's easy. So every time it breaks the high, you know the market is going on an uptrend. But now what happens when the market breaks the low? Let's actually make this red over here. What happens when the market breaks the low? Okay. This is how you know when the market is starting to make a downtrend, when the market is breaking the low, right? So if a market breaks the high, the market is making an uptrend. I know I'm being repetitive, but it is for a reason. Give me a second here, guys, right? So we know every time it's breaking the high, it's making an uptrend. But when the market begins to break the low, the market is starting to make a downtrend, okay? Every time it breaks the low. So this is what happens. What we're looking for is when the market, for step 1, breaks the low in the market, okay? When it breaks that low in the market. When it breaks that low, we call that a BOS, or something known as a break of structure. Very, very simple. So let's take a look over here. Over here, we can clearly see what? The market is breaking the highs, going higher, right? Breaking the highs, going higher, right? You can see the market breaking the highs, going higher, breaking the highs, going higher, but eventually the market stops breaking the highs. And what happens over here is the market starts to create the lows, and the market starts to break the lows. Let's make this red, right? The market starts breaking the lows, right? We see over here the lows, the market starts breaking the lows. Can you guys see how this candle right here, can you guys see how this candle right here has broken the previous lows in the market? I need you guys to let me know. I got to make sure I'm asking the right questions. Can you guys see how this candle right here is breaking these lows inside of the market, right? We could see it. Very, very simple. It's so simple, okay? So again, if it's breaking the highs, it's going up. But the minute it starts breaking the lows, we know the market's going to start coming down. So this is very important for us. So why is this so important? This is so important because of this, right? Let's come over here, and this is what we're going to do. Once we see the candle that breaks the lows, we're going to label this as a BOS, right? We're going to say, okay, there we go. We have a break of structure. This market's starting to turn around, baby. Starting to come down. It's going down. So what we're going to do is we now want to find, and we say, okay, now that we have this break of structure, what we're going to do, and I'll bring this to a smaller time frame just so the candles look a little easier to follow. Okay, we're going to come to a lower time frame. And now what we're going to do is we're going to backtrack the breakout, and we're going to look for the highest candle that started the breakout. Okay, we're going to look for the highest candle that started the breakout. All right, so there are going to be two candles that started the breakout. So if we come over here and we look in this move, we're looking for the highest red candle. We're looking for the highest red or the highest blue candle. That's what we're looking for. We're looking for the candle that started the breakout. So I could use a few different examples. I can use this one, or I can use this one. They're both the same, so it doesn't really matter. So what we're going to do is once we identify the highest candle, right, we're going to take the highest red candle, we're going to take the previous candle, and we're going to highlight that entire candle right there. Okay, we're going to highlight that entire candle across the charts. Extend right. Okay, we're going to highlight that candle right over there. This candle right here is known as our liquidity block. We'll just call it the LB. This is known as our liquidity block, because this was the highest candle before the market stopped and it started the breakout. Does that make sense to everybody? And you could do this on any time frame, literally any single time frame. I see Mira is asking the host. You can do this on any time frame, and I can show you multiple examples. All righty. And if you come over here all the way to the high, you can even use the highest candle right over there as well. Right? I'll come over here. I'll look for the highest red candle, and then I'm going to highlight the blue candle before it, right? And that's going to be my liquidity block. So right here, I have two different liquidity blocks right over here. These liquidity blocks, these are the hidden support and resistance. These are the only levels in the market that matters, because these are the levels where the banks are piling up all of their money. Remember, 10,000 lots to move the market 1 pip. So you want to find those support and those resistances, what we call liquidity blocks. You want to find those areas, because you know when the market goes to those areas, the market is going to move. So once we find the liquidity block, what I then do is I would just mark up 50% of the block. That's it. I'll go ahead, I'll go to half of the block, and I'll mark up 50% of the block. And then from there, I'm just looking for the numbers. So I try to look for nice round numbers. Like this number is 1.707211. So what am I going to do? I'm going to round the number off. 1.70200. All right. That is our points of interest. So we are interested. We're only interested in Euro NZD when it reaches 1.7200. And if we come over here to this liquidity block, this one is around 169,650. So this POI is 1.69650. Okay, we always want to use whole and half numbers all the time. So you don't want to put 1.6953. Always put whole and half numbers. So here's our second point of interest, 1.69650. So we're only interested in Euro NZD for a sell when Euro NZD comes to these two numbers. Is this making sense to everybody so far? Okay, type of 1 for me if this is making sense. Okay, and I can give you another example. I could do them way faster after this, but I want to take some time here so that way you understand. We need to find those liquidity blocks. So this right here is all of step 1. This is 50% of the strategy, because what you're going to notice is once you come on over to the market, you will notice the market will come right to these areas and they will drop it like it's hot. Okay, they will drop it like it's hot from these two areas. Now, remember, let's go back to a price model. That way I can help you guys understand something. Ready? Let's come back over here and let's take a look. What did we say about step 1? Step 1 was that they're going to accumulate the orders. They're going to drop the market, absorb the liquidity. They're going to bring the market back up to fake you out, and then they're going to drop the market. Does that look, let me delete this harmonic scan. Does that look exactly like what just happened here? Do you guys see it? Can you guys see it? Do you guys see it to a T? This is called a price model. Okay. Where is this? Market was accumulating the orders over here. Market dropped off. Bingo, right over here. So now all the sellers are like, yeah, baby, I'm selling this thing. But then the buyers, right? I mean, well, this was also another liquidity block for sure. But anyway, the buyers get in. The buyers are like, yeah, baby, yeah. And then boom, banks come here, and then bing, bing, bingo, market drops it like it's hot. So this happens again and again. Pardon me. Again and again inside of the market. All right. So that is a liquidity block. Okay, I'm going to save that. So that is step 1 of the strategy. Now, as we come over here, I'm going to go through the 3 steps. Okay, because I got about 10 minutes. So I'm going to go through the other 2 steps, which are pretty quick. And then I'll show you 2 or 3 more examples, or you can look through the harmonic scanner for yourself and see how well they work. Okay, so that's step 1. Now, what is step 2? So if you guys have ever watched, we have a new package in IM Academy called SFX, Miss Carolyn Barodin. Now, I'm going to give you guys a little bit of a secret. I've actually been learning from Carolyn for the last 5 years. When I first partnered up with IM Mastery Academy and I was getting mentored by Christopher Terry, our CEO, he actually introduced me to Carolyn Barodin. And I went and I learned from Carolyn Barodin. I just obviously never brought up her name. And it's so amazing that she's here because Carolyn Barodin is a certified market technician. This is a woman who goes on the news, gives professional stock trading advice, has thousands of students around the world. You can learn from her here in IM for $275, or you can buy her course right now for $5,000. Like, I need you guys to understand the value that you have here at IM and how much this company loves the members here. Okay. So Carolyn Barodin taught me one of the most valuable lessons I've ever learned inside of trading. And the lesson was this, and I'm going to ask you guys this question. How many of you guys have went to an area where you thought you may want to sell, but then you got nervous and you was like, oh, I'm at my resistance. I should sell, but should I sell? I don't know. Should I sell? Did that ever happen to anybody here? Type a 222 for me in the chat box if that has ever happened to anybody, right? You'll mark up a chart. You'll create a support and resistance. I'll give you an example, right? You'll come over here and you'll make a whole entire resistance, a whole support. What's going on with this, right? You'll come over here and you'll be like, oh my goodness, look, this is a support. And then when it gets there, you don't even know if you should even buy it or not. You're confused. You're perplexed. Your mind is running games on you, right? So what did Carolyn teach me about this? She said that for every setup, ready, and this is step 2, every setup requires a trigger. If there is no trigger, there is no trade. When the market comes into your zone and you are ready to sell, that doesn't mean that you're ready to sell, because the market can come to the zone and just blow past your zone. So you want a trigger, you want an extra confirmation to say, you know what? I want to make sure that this market stops all this bullish momentum and going to the upside. And I want to make sure that the market is going to turn around and start coming down. Okay. I want to be more certain that the market's going to turn around and start coming down. So that is what step 2 is for. Step 2 is every setup requires a trigger. Now, once you're in an entry zone, which is the liquidity block, it's going to be time to identify the exact candle where the trader's control has went into your favor. So if you're selling, you want to find the exact candle where buyers are no longer in control and sellers are now in control. That's what you want. That's your trigger. So you know exactly when the market's ready to move. Now, most people don't know this, but candles are actually just this. It's like the human body. This is the soul of a candle. This is the inside of a candle, but this is what the external looks like. So we have a body and we have a soul. The candle is the body, but the volume is the soul, right? So we have to see, when is the soul changing in the market? When is the market going to go from buying to selling? Okay. And we do that by looking at step 2. So the step 2, the trigger is very simple as well, right? So step 2 for the trigger, this is what we do. I'm going to simply open up right over here, right? We're going to open up our, what do you call it? Our indicators. And what we're going to do is we're going to simply look for when the sellers are in control. So it's all color coded. If you're selling, you're looking for red confirmations. If you're buying, you're looking for buying combinations. And now these are not just any indicators. These indicators are a combination of volume, liquidity, trend, momentum, and volatility. Okay. It's all these confirmations lined up. So it's not like it's 20 RSIs and 20 Stotches and, you know, all this weird stuff. Each indicator here has a specific purpose and a specific reading for a specific entry. Okay. I didn't just throw this together. So what we're going to do is we're going to do this. The first thing we're going to do is inside of the entry zone, the liquidity block, we're going to look for a crossover candle. So you guys see that red candle that's crossing over that blue line? The first thing that you want to look for is you want to look for a red crossover candle. Now, once you have a red crossover candle, what do you do from here? You want to look directly down your chart and you want to make sure that everything is red. So if you have a red crossover here, you have a red bar here, you have the red above the blue here, and then the most important one is the trader's control down here. You want to make sure that the red is also above the blue right down here. So you can see the red is above the blue, but before you enter, you always want to make sure that the black line is above the red line. All right. And that's going to come into place when you're ready to enter, which is step 3. So step 2 right here, we just want to make sure everything is lined up. So I'm going to ask you guys, can everybody see here, red arrow, red bar, red line, red over the blue down there? Can everybody see that? Just type a 4 for me inside the chat box. If you could see all 4 confirmations, like, you know, everybody can see it. Can you see all 4? So when you see all 4, that is the trader's control. That is letting you know that this exact candle right here, the sellers are now in control. Less consolidation and more profit. And take a quick look. Less consolidation and more profit all the way down. And guys, look, I don't know if you guys can see it, but can you also see the smart money price model? Accumulation, breakout to the downside, market pull back up, liquidate the traders, and then the market drop off. Can you guys see it? Once you see it, you cannot unsee it. So it happens on bigger time frames and it happens on smaller time frames. It's really amazing. Don't let this go over your head. All right. So that's step two. Step two, you just want to simply make sure that that the sellers are in control and you are ready to get into this market. Okay. So at this point, you should be very excited. And then now you go to step three. All right. So what is step three? Step three is all about sniper entries. How many of you guys would like to get in? No, you're gonna learn what I mean. Uh-oh, what is this doing over here? Oh, the enemy is at work. What's going on? There we go. I've never had this happen before. Let me save this. Let me come here. Let me go back there. I don't know what I did, but this chart keeps moving. I don't know how to stop this. All right, but anyway, no, there's nothing on my mouse pad. No. All right, anyway, let me go to step three. So step three is the sniper entry. How many of you guys would like to get into trades that I know nobody likes drawdown? So instead of going 20, 30, 40, 50 pips in drawdown, waiting for the market to go back in the direction, how many of you guys would like to be able to get into a trade that has maybe 5 pips, 10 pips, 15 pips drawdown? Like it's quick drawdown and then quick profits. How many of us would like that? That's what step three is all about. It's all about the sniper entry. Nothing beats a sniper entry inside of the market. So we take advantage of something known as fair value gaps or market balance to get the absolute best trades for reduced risk and max reward. So what is basically an imbalance? It's simply this. Every single candle is supposed to be covered on both sides by a wick or a candle. So if you ever see a candle that has no wicks or no body on both sides of the candle, then there's an imbalance. And what ends up happening is the market will usually come back up to fill out that imbalance to then take the market down into profits. So let me show you what I mean, right? Let's come over here. Let me refresh this here really quickly. Okay, let's go back to your NZD. Thank you for the person who said to refresh this. Let's go back down to the 15-minute and let's take a look. Are you ready? Okay. So again, we're going to look at step two. Ready? Look at this. Step two, red crossover, red bar, red over the blue, and we see red over the blue. So black is not above the red yet, but red's above the blue, red's above the blue, red bar, red thing. So once this candle closes, right? Once this candle closes right here, let me show you. Once this candle closed, this next candle opened. Now, most of us have been trained to get in the market once the candle closes. There is nothing more dangerous than that because it's very rare. If you understand how momentum works, sometimes the candle will close and then keep going. Most of the time, the candle is going to pull back. So what we do to find step three is very simple. Once the entry candle closes, we're going to look at the candle right before this, right? I can't zoom in any closer to this, but we're going to take a look at the candle right before this. And what we're going to do is we're going to go ahead and we are going to create an entry line at that previous candle's wick right over there. Okay, that's what we're going to do. We're going to create a candle at the previous wick. Now, if you want to create a range, then you can use the previous two candles. That's going to be completely up to you. So once this candle closes, you're then going to go to the previous candle to set your line. And these are going to give you the exact entry prices to get back in the market. So all you are waiting for, okay, all you're going to wait for now is once this candle closes, you're going to wait for this market to pull back up, to pick up your order, and then you're going to get inside of the market. And that's how you get into almost immediate profits. So if you take a really, really, really good look over here, if we even go all the way down to the 1 minute, okay, you can see right over here. Let me take this out. You can see right over here, even on the 1 minute, take a look. Take a look. This is where your candle closed, right? The black line was right down here. This is where your candle closed. As soon as your candle closed, your candle pulled back up to your entry, and now you are in the trade. And if you see from here to here, that is 17 pips. Now, what if this was a bad trade and you had a stop loss up here? And if you had a stop loss up here and you entered when the candle closed down here, your stop loss is over 50 pips. That's a big stop loss. But if your entry was here, then your stop loss is 30 pips. So you see, you get to shave off a lot of unnecessary risk by being a little bit more specific with the market. So by doing this, this gives you the 3 steps that you need to get into the market. And this right here is SmartMonics in an eggshell. Very, very simple. Okay. Now I know I have to get off of this. So I'm going to pass it back to Abdullah in 1 second, but let me give you guys another quick example. Are you ready? Here is USD CAD. USD CAD had an imbalance, right? Came over here, market's in the entry zone. We come down to the 15-minute. What do we do here? Let's take a look. We're going to wait for the entry candle inside of the market to wait for everything to pretty much line up in our favor, right? When we look for everything to line up in our favor, now this one was a little, twisted down at the low, but it was still good. Once everything lines up in our favor, okay? Once everything lines up in our favor, we're going to go to the previous candle. We can go to that candle or the next candle that covered the back of the candle. We can cover that candle. And there goes step 3. And look what the market does. The market came back up, picked up your order once, picked up your order twice, and then the market dropped off just like that. I teach this every single day. I do these price models every single day for you guys, ladies and gentlemen. So this is the 3-step SmartMonics strategy. If you guys want to learn more, I encourage you guys to watch my SmartMonics video. I encourage you guys to rewatch this. And I also encourage you guys to simply get on my live sessions, come make money with us. And if you're not confident at first, come on for a week, learn the strategy, see what I'm doing, see what I'm saying, trade on a demo, get your confidence in me, get your confidence in the strategy, get your confidence in yourself. Because with confidence comes certainty. And with proper risk to reward, family, I'm telling you guys right now, you will be surprised at how much money that you can actually make inside of the market. Most people think the strategy is the golden ticket, but it's not. It's the risk to reward. So we're getting you into 1 to 2, 1 to 3, 1 to 4, 1 to 5 risk to reward trades. That lets you risk a little bit and make a lot. When you lose a little bit. When you win a lot. And we've been doing this every single day on Go Live. So I really encourage you guys coming, learning more. I know it could be a few extra steps, but I'm going to say this last quote and I'm going to pass it back to Mr. Abdullah. Les Brown said this. He said, if you do what is easy, your life will be hard. But if you do what is hard, your life will be easy. I believe that trading can be a challenge. It can be. But if you steer away from all of the challenges and all of the obstacles in your life, how will you ever grow? See, a challenge equals a change. If it doesn't challenge you, it doesn't change you. And if you're not changing, then how are you growing? And if you're not growing, then guess what you're doing? You're dying. Because there is nothing that stays the same. The only thing that is permanent in life is change. That's the only thing that's guaranteed. So every single day, you're either digressing or you're progressing. So if you guys want to progress, you guys want to challenge yourselves, guys want to learn a strategy that works, you guys want to make money on the charts, you guys want to follow a trading plan, I promise you guys, Abdullah will have me here on another call for you guys, and I will be on Go Live every day, Tuesday, Wednesday, and Thursday for you guys, dishing out these trades. All right. So again, guys, look, my name is Manny Quinones. And yes, you can do indices, you can do gold, you can do stocks, you can do everything with SmartMonics. The harmonic scanner plus the smart money combination together is a lethal combination. I've seen it work in every market and on every single time frame. All right. So Mr. Abdullah, again, I want to thank you. I'm not sure if I need to exit out the call. I know you're at an event and I went over a few minutes, but I want to thank you so much for allowing me to be here, allowing me to help you, coach the team, and just thank you. I honor you so much, brother.
Thank you very much, sir, for coming on the call. Literally, it was such a privilege, honor for us to have you on the call, not just on the Zoom call, especially for this team. So guys, I'm sure you learned a lot. Let's show our appreciation. Let's again put 777 fire in the chat. Monday, Tuesday, Wednesday. You don't need to worry. You can't miss him. Monday, Tuesday, Wednesday, 1 o'clock UK time, which is very ideal in Europe, 2 p.m. in the afternoon. Wonderful time for all of us to connect through his call on the Go Live. Sir, thank you once again from all the way, the strategy, the mindset, the psychology. You have gone through everything. Super grateful for that.